Hello, investors and traders, and welcome to the Midweek Report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Before we get started with the midweek analysis, I'd like to point out for the brand new folks and those who are just joining us here on YouTube for the very first time that I use a 7-point trading checklist that I put together to analyze the markets. And the results that we've been getting over the years has been second to none. You can see here in the diamonds, these diagonal lines here, and I'll zoom in as we go through each one of the major market ETFs, are past forecasts. And you can see here that we still have an open downside target on DIA at 411.32. Now, using my 7-point trading checklist, I look at the candle and then I analyze the volume and how that relates to the candle, because volume is actually a leading indicator, not a lagging indicator, as some may think. This is according to Dow theory. Charles Dow, over 100 years ago, stated that you need to see volume increasing in the direction of the trend in order to confirm the trend. And as you can see here, we're seeing some down candles, and the volume is increasing on the way down. That's telling us that the bears are in force, the selling activity is still increasing, and the momentum is also pointing to the downside. If you take a look again, I look at that volume, then I go right down to the oscillators. Yesterday, we had a cross in the stochastic over the %D. Now, if you're brand new, I'll slow down just a little bit here. The blue line is the %K that was developed by Ralph Diston in Chicago years ago in the mid-'80s. And then he threw a moving average on top of the %K. It's a 3-period moving average that's known as the %D. When the blue crosses the red, I'll make it very easy for you, that generates a sell signal. So that's still showing downside momentum. The sell signal on the CCI down here, which is the Commodity Channel Index, developed by Don Lambert in the mid-'80s. This was the rage back in the 80s when computers were coming to the trading floor. All these formulas were being developed and indicators were being developed to forecast the markets. Don Lambert states that when his indicator, the CCI, drops below the red line, as you can see here as I magnify that, that generates a sell signal. Now, the interesting thing about the CCI is you could see there's a black line in the middle known as the zero line or the momentum line. When the CCI crosses below the momentum line, we generally get a continuation of the move in the direction of the cross. And I found that 2 to 4 days is the norm. So what that means is with this red candle closing below the 20-period moving average, that momentum cross is telling me we have about another, on the low end, 2 more days of downside pressure. Now that's getting us closer to that downside target of 411.32. We could even zigzag our way down to that target down there with an A to B, pivot back up to C, then pivot lower to a D. That's an ABCD pattern that I talk about quite often. If you'd like to learn more about that, you can go to our StickyTrades website and sign up as a member. We also have a free 15-day trial that you can use to get your feet wet here and plug into some of the webinars that I'm doing. But as a member, you also have access to our StickyTrade University. And this is a very robust and very interesting course that we have over a series of courses that explore technical analysis. We talk about options. We have it. And you could measure your progress as you go through each one of the courses. All right, so that is our StickyTrade University. Moving right along to IWM, this is the small cap ETF that basically tracks the Russell 2000. Again, see these diagonal lines here are my forecasts. Now, I made a little bit of a change where my downside forecasts, I changed those to red. My upside forecasts, I made those lines green. And if I go back, you could see that each one of these have been hit. And, I get a lot of debate about how right or wrong these charts are. It's not a matter of right or wrong. It's about your percentages. And you can see here, this was a two-part forecast where I had up and down. Both those targets hit. And then after that, and you can follow along because each one of these forecast lines were originally drawn on weekly market reports. I don't do it on the midweek report, but you can go back to these dates and you can go on YouTube and look for the same date and follow along with my analysis as I drew that line. And you can see how often these targets hit. Upside hit, downside hit, downside hit, upside hit. Downside took a little while, it hit. That downside target hit. This upside and downside target hit, downside target hit. You see where I'm going with this. So you look at IWM, just at a glance, the majority of these are hitting. The only one that has not yet hit is this one here, which I do believe it will hit. That downside target's still in place at 212.78. So if you go back and calculate the number of times that these targets have hit, you'll see that's over 90% of the time those targets hit. Now, if this one hits, it'll be 100% for IWM, not so much for SPY, but the percentages are anywhere between 70 and 85%. On equities, we're tracking an 82% hit rate. And tonight, on our rapid fire stock analysis session from 6 to 7, I will be analyzing at least 50 stocks. So I analyze hundreds of stocks throughout the course of the month, and we're tracking 82% hit rate on those individual stocks and ticker symbols that are submitted to us by our members. So again, as a free member, you have the opportunity to submit your own ticker symbol and I'll analyze the stock. So again, downside target is 212.79 for IWM. Moving right along to the Qs. Had a tough day today in the tech sector, but look at that, closed below that 20-period moving average. The last time we closed below that moving average back here, we had a continuation of that downward leg you see right there in what is known as an ABCD pattern. See, here is the A. It went to B. It pivoted up right here to C, pivoted right back down to a lower D. I think we could see the same thing happening. As I mentioned weeks ago, this downside leg right here looks like it's duplicating quite nicely with the beginning stages of the fallout below the 20-period moving average. Looking down below, you got that volume increasing on the way down. Oscillators are going down. Momentum cross right there on the 0 line. So downside target still in place for the Qs right there at 464.86. Now, looking at SPY, this is the S&P 500. It's basically going to be the same story. We still have an open target right there at 550, 558. Leaving that in place. Look down below. We barely nudged below that 0 line. See that blue bubble off to the right? It's minus 8.8812. That's below 0. So we have 2 to 4 more days of momentum in the direction of the cross, which again is to the downside. Looking at the VIX had a massive green candle today, then closed off the highs, but this is very close to an inverted hammer. We see these inverted hammers showing up with the long shadows, usually at the bottom of a downward leg. When you find them at the end of a downward leg, they are bullish. When you find the long shadows at the end of an upward leg, they're bearish. Remember those shadows. Very, very important that you keep an eye on not just the length of the body, but the shadows and where those shadows are located. Now, I just want to mention one more thing. One of the big news blasts that came out yesterday was in McDonald's. They have an E. coli breakout. I think McDonald's is most likely going to rally. I'm just throwing that out there because we did hit my downside target on McDonald's today, which was left 2 weeks ago at 295. I think that the news is more of an overreaction here, and I think that we could see a little bit of a bounce. So stay tuned for that. But there's another thing that's happening that's in the 10-year note. If you look at what's happening with interest rates are over 4.24 right now, and they're still climbing. This could put some pressure on the real estate market as it becomes a little bit harder for people to afford mortgages at the higher rates. I'll talk more about this on Friday. For TNX, I think we could see a very short pullback, and then we'll have to see whether or not we get a pivot. Talking to Tim from Bear Mortgage as he's heading over to Mexico to do some charitable work and build some houses for those who are less fortunate. His comment to me was that if TNX pulls back, we could see rates all the way back up to 5%. Now that's very interesting because if you look at the TNX, we've got an open gap up there right around 4.8 to 5%. And so that could put a real hurting on the real estate market, which is more or less a leading indicator to the economy. And I've been talking about us already being in a recession. They just haven't used the R word to identify it as such, being that we're in election season here. But I'll have a lot more to talk about on Friday. Stay tuned and stay connected to Sticky Trades. Thank you so much for liking and sharing and commenting and hitting that notification bell. We're getting a lot more subscribers over the last couple of weeks than normal. I appreciate that. We at Sticky Trades make a commitment that we're going to underpromise and over-deliver on our content. I guarantee you. That's the way I was brought up. That's the way I brought up my kids. And I promise you that we will underpromise and exceed your expectations for sure. Have a good rest of the week, and I'll talk to you on Friday. So long.